With me today, I have Bruce Stout, manager of the Murray International Investment Trust, which is included on Interactive Investor's Super 60 rated list. Hello, Bruce.
Hello there.
Bruce, there are a lot of income funds around. What would you say to investors thinking of buying Murray International? What's your pitch?
Well, I guess it's not changed from what it's always been, actually, and that is that, I mean, one of the great dangers of income funds, I think, is when you have a concentration of your income coming out of one sector or one area. And in my time in investment, I've seen it a few times where something happens to the banks and the banks have all got dividends, and then suddenly all the dividends evaporate, or house builders or construction or whatever. And what we've done over the last 15, 20 years really is to fully diversify Mint as much as possible. Up before the crisis, there's about 4,500, 5,000 companies in the world that have dividend yields and pay good income. Only 250 of them were in the UK. So there's a whole world out there in order to diversify an income stream, and then you don't become just dependent on one sector or one industry or one country. And that's what we've always seek to do, because we want to earn the dividend over time. And we certainly have done that. And in the last 10 years alone, we've put 30 million into revenue reserves. So the revenue reserves in Mint of 75.5 million represent more than a full year of dividend cover. And that's been put away for a rainy day. This is a rainy day. But we hope Murray International will emerge stronger from this at the end of the day.
Well, you partly answered my next question. I was going to ask, the trust, it has one of the best dividend yields around. I was going to ask about dividend security. How secure is the payout currently, and your outlook for dividend income over the next 6 to 12 months?
I think the short-term outlook for dividend is really, really difficult to predict, because what we've seen in the current crisis is that some companies that are really high quality with good balance sheets and lots of cash have still not paid dividends because they've been very cautious. And a lot of businesses that we talk to have actually withdrawn giving trading statements or any predictions for this year whatsoever. And that is understandable, because we're only actually 3 months beyond the sort of peak scare time, but we don't know from a clinical point of view whether there'll be a second wave, whether the release phase will work properly, or whether we're going to go 2 steps forward, 1 step back. It's very, very uncertain from a clinical point of view of the world at the moment. So from an investment point of view, from a dividend point of view, we have to be very cautious until we see, how the world gets back to normality, or whatever that normality is. I would say actually at this point, the consensus view is that it's going to be a V-shaped recovery, because that view, I think, was shaped by what happened in 2008 and 2009. And therefore, the deeper you go in, the faster you come out. But there's no evidence for that whatsoever. We don't know what the shape of a recovery will be. So we have to be very cautious.
So we've talked about the balance of the portfolio in terms of geographies already, and you've talked about the company being more important than the country. But how are you comfortable with the balance of the portfolio at the moment? Do you think this might change over time, and if so, perhaps how?
Yeah, I can definitely say with certainty that it will change over time, because it always has changed over time. So if you go back 10 years or you go back 20 years, the current portfolio will be very different from then, because it evolves with the opportunity set that comes with different companies, maybe starting to pay dividends that never did before. It will evolve depending on where the best relative value can be found. And that's just what happens in investment. It's a constantly dynamic process as the portfolio evolves and changes. And the way it is at the moment, we're comfortable with the types of businesses we own. We've certainly seen more tech companies in the last few years starting to pay dividends, which has given us more optionality. So large holdings like Taiwan Semi and Samsung Electronics now. And having a global remit is a mandate where there is great flexibility. So, if there is only one area where you can get tech or one area where you can get pharmaceuticals, then we can look at it and invest accordingly because of the broadness of the mandate. So quite comfortable with the way it is.
Well, you mentioned a couple of your the tech companies that you own in the portfolio, and it very much is a mix of old and new industries. So you have the tech stocks like Taiwan Semiconductor and Intel, and you, alongside British American Tobacco, Total, and Philip Morris. So this is deliberate diversification, or is it just about yield, pure and simple?
Yeah, well, it's certainly not just about yield, because we don't ever buy a company for yield. You buy a company for dividend growth, and you must buy a company that has a balance sheet that can support dividend growth over a long period of time. And the main reason why companies like Thailand Semi and Samsung that I just mentioned are now delivering good income, good dividends, is because they're growing quickly, they've got a lot of free cash flow, and they've enough to invest in the business and still pay a rising dividend that has been rising significantly over the last few years. And in terms of the older type companies that you mentioned, I think you see a reduction in those types of businesses, which is almost a natural reduction over time. But what we're looking for in Mint is balance. We don't want too much of one thing or too much of the other. So there's a balance between value, if you like, and growth, if you like. So for each Thailand Semi with high growth in dividends and high growth in earnings, it's offset by something like Thailand Mobile that is much more stable in terms of lower growth and lower earnings, but of course a much lower price and valuation. So it's that balance that we're seeking on a total portfolio basis that gives you the mixture of what some people perceive as old and new type businesses.
Again, we've talked about how difficult it is, or more difficult, to find yield at the moment. So you're the expert, Bruce. Do you have any words of wisdom for investors seeking yield right now, and who may have seen a big decline in income from their portfolios?
Yeah, I think it's very, very difficult for investors at the moment. Often they get a snapshot every quarter of what the portfolio holdings are, and they'll be very conscious in things like the funds that they own, where the dividends are going. There is a great attraction of investment trusts, in as much as they do have, or many of them do have, a retained income from previous years that can be paid out to smooth the dividends during a bear market for dividend. And this is a bear market for dividends, I can assure you, a really severe one. And there's actually only been about 6 in the last 150 years, compared to maybe 16 actual bear markets for equities. But the thing that we do know is that a bear market for equities tends to last 1.5 to 2 years, because stock markets discount improvement and move ahead of improvements. But when you do get a bear market for dividends, and I've said there have been relatively few, but when you do, they last longer, because the companies have to rebuild the balance sheets and have stronger balance sheets before they're comfortable in reinstating dividends and starting to pay again. So you need to have patience. You need to have diversification at a time like this. And it is tough, but so many times in history, when we look back, just being patient and waiting patiently has been the right strategy.
Bruce Stout from Murray International, thanks very much for joining us today.
Thank you very much.